Every year, Which tests thousands of the products that you rely on every day. And we've been doing it for over 60 years.
Which reviews are 100% impartial. We don't accept freebies from manufacturers, and we have no owners, shareholders or government departments to answer to. So our work is on behalf of you, the consumer.
In a world of misleading claims and fake reviews, we test everything, from everyday items to big purchases, so that you don't have to.
We then put them through tests and assessments that go beyond the accepted standard to work out how well these products work for you and what's not worth your money. And a Which membership not only gets you access to our reviews, it also funds our non-profit campaigning work, like getting scam ads banned on social media and ending broadband and mobile mid-contract price hikes. And right now, podcast listeners can become a Which member for 50% off the usual price by heading to which.co.uk/podcast offer. In October last year, the economy was forecast to grow by 2%. Today, that figure has been halved. So what does that mean for you and your finances? I'm Lucia Ariano, and this is Which Money. Welcome to the show. Now, we're with you earlier in the week than usual today to bring you our reaction to the Chancellor's spring statement. This was Rachel Reeves' biggest speech since her budget in October, and here's how she concluded her statement in the House of Commons this afternoon.
There are no quick fixes, but we have taken the right choices, returning stability to our economy after years of mismanagement by the party opposite, delivering security for our country and security for working people. That is what drives this government. That is what drives me as Chancellor. That is what drives the choices that I have set out today. And I commend this statement to the House.
And on the other side of the House, here's the closing remarks of Mel Stride, the Shadow Chancellor, in response.
Today's numbers confirm it. We are poorer and we are weaker. To govern, Mr. Speaker, is to choose. And this Chancellor has made all the wrong choices.
Okay, so joining us today to look at the big headlines, we have Which Money writer Matthew Jenkin. Hello, Matthew.
Hi there.
And also welcoming back Head of Money and Markets at Hargreaves Lansdown, Susannah Streeter. Hello, Susannah.
Hello, lovely to be here.
So good to have you both on the show today. Okay, so shall we start with a little context then? You know, what are the key headlines from today in a nutshell? What's the general feeling after the announcement? Matthew, do you want to start us off?
Yeah, so interestingly, from a personal finance perspective, there wasn't a lot in it. After all the sort of rumours and speculation about what could be in it, it was very much, as the government had been saying all along, that this wasn't going to be a full budget, that this was simply going to be, they're going to outline sort of growth forecasts and also, as we expected as well, lots of news about sort of spending cuts. But in terms of the nitty gritty, there were a few sort of nuggets in there in terms of taxes. There was confirmation that they're not going to raise taxes as they've been promising all along. And there were some more details provided about planned benefits reforms.
Well, we'll definitely dig into some of those headlines or so-called headlines as we go on. But Susannah, what's your reaction? Was it as expected? Was it underwhelming?
That's exactly what the Chancellor wanted, a budget with no big surprises, which is why many of the announcements have been made beforehand. What she didn't want to do is spook the debt markets in particular, and to show that she has a hand on a steady tiller in terms of guiding the economy. Of course, there was disappointment about the outlook for growth for this year, with the forecast slash from 2% to 1%. But looking ahead, the forecast for growth was actually upgraded in next year and the years after that. So you saw initially a bit of a negative reaction on the financial markets, such as the FTSE 100 and the FTSE 250, but then there was a rebound as optimism grew, that actually perhaps it wasn't as bad as first had been thought. And that's really, I think, what the Chancellor really could have hoped for. We got the FTSE 100 and the FTSE 250 in positive territory by the end of the day. There was initially a little spike in UK gilt yields, but then they dropped back again. So that message of stability, I think, has come through loud and clear ultimately.
I suppose it would be fair to say then that it really wasn't as big an affair as the budget, Matthew.
No, absolutely not. And as Susannah said, I mean, that was probably the intention. Rachel Reeves was very careful not to sort of rock the boat today. And any sort of announcements that were in there, we already saw coming anyway. They have sort of very much sort of insisted that there's only going to be one major fiscal event in the year, and that's going to be the autumn budget. So we'll just have to wait till then to see, if she's going to pull any sort of rabbits out of the hat.
So should we talk a little bit more then about the growth forecast? Susannah, what's the general feeling here? Are we disappointed in this year's growth figures? Is the industry disappointed?
It was as expected, really. We already had the Organisation for Economic Cooperation and Development announced that it was revising downwards the UK's growth prospects, but also it revised downwards growth prospects for a whole raft of developed nations. And it's put the blame squarely, really, at the foot of Donald Trump and his tariff policy, saying that the outlook for the global economy is now more uncertain because of the impact on trade and because the UK is so closely intertwined with the global economy, it is affecting the UK as well. So when Rachel Reeves said that we're, effectively living in uncertain times and the world is moving very fast, I think it's fair to say that she's not the only one saying that. The OECD has said that. That's why it downgraded its forecasts. And so a downgrade to the UK's growth prospects for this year was expected. Interestingly, what wasn't expected so much was the fact that the OBR, the Office for Budget Responsibility, the kind of independent forecaster, was going to upgrade the UK's growth prospects in the years following this year. And that's partly because of the investment that the government has outlined, for example, in building new homes and that was one of the reasons why the OBR has upgraded the UK's growth prospects going forward. So I think on balance, it was more positive than expected.
And for our listeners, will this mean anything for their pockets right now, Susannah? I mean, these growth forecasts, what do they mean for us, on the ground?
Well, the OBR, the Office for Budget Responsibility, has said, according to its calculations, that real incomes will have risen by around £500 on average. It's calculating because of what the government has brought in. And so that obviously is better news for companies relying on people spending in the economy. And so you saw that effect coming through in terms of market movements a little bit. So what it's saying is, yes, there have been all these changes, but we're having the implementation of the increase in the minimum wage coming in April. And so ultimately, it's saying that largely households will be better off because of the government policies.
Okay, well, that sounds, quite positive. It's good to have a little bit of positivity. I mean, something not so positive are the welfare cuts, potentially. 3 million families I saw are due to be hit by these cuts by 2030. Matthew, do you want to take this one? Big changes to welfare. What's happening here?
Yeah, so there's going to be a raft of changes to the benefit system coming up from next year. So I'll just run through some of the main ones. If you claim personal independence payments and don't qualify when the criteria are tightened, then you're likely going to be the hardest hit by these reforms. Some 370,000 people are expected to lose their entitlement altogether, and others are going to receive less than they expected. The average loss is £4,500 a year. Even if you're not affected by the PIP changes, as you mentioned, lots of people are going to lose out. Overall, by 2029-30, some 3.2 million families are going to see cuts. Average loss of £1,720 per year once inflation is taken into account. And finally, universal credit was a big thing that was mentioned in the speech today by the Chancellor. The government said that there's going to be a rise to the standard allowance for universal credit for 6.5 million people, so 6.5 million people. It's going to rise to £106 a week for a single claimant claimants aged over 25 in 2030, rather than the £107 previously mentioned in the plans last week. So that was a slight change to what's already been announced. The health element of universal credit is also going to change. That's paid if your ability to work is limited. That's going to be halved for new claimants to £50 a week in 2026, 2027. And it's also going to be frozen thereafter. There was an initial announcement that this wouldn't affect current claimants, but that's also going to change. They're going to be brought into these new reforms as well, and their entitlement's going to be frozen at £97 a week until 2029. 30. So lots of changes.
And Susannah, what do you make of these changes? Were they expected? I mean, it sounds like they're going to be hitting people quite hard.
Yes, they will hit some people hard, and it's obviously a really difficult time, but the government has some very difficult decisions. I mean, you look at the numbers, the UK spends more than twice as much on benefits for working age people as it does on defence each year. We've got ultimatums from Donald Trump that he is not prepared to stand by and allow the US to keep funding Europe's defence. The US has been a big contributor to NATO budgets. Really putting in so much more as a proportion of GDP than European nations, and is unwilling to do that much longer. It's been a wake-up call for European nations that they have to spend more on defence. The UK has now committed to 2.5% spend as a proportion of GDP on defence, upping that from 2.3%. And we've got this extra spending on defence of being brought forward of an extra 2.2 billion. It's a difficult decision, but given the threats that Europe is facing right now, and the prospect that they may have to go it alone if there's an attack by Russia on a NATO country, you can see why it's concentrated minds at the government and the Treasury that actually they have to do something to really reduce the welfare budget and spend a bit more on defending the nation. They have allocated £1.5 billion to try and help those working age people receiving benefits get back into the workforce. So the cuts were 4.8 billion in the welfare budget, but 1.5 billion will be spent on trying to give them the support they need, the personal support they need to get back to work. It is difficult, but certainly many people would say, oh, I would rather be working than not working. But the problem is the system hasn't enabled me to do that. We'll have to see if these changes will help.
Some very difficult decisions for sure, especially given, the cost of living being so high. And on that, inflation did come up today. Matthew, inflation figures this morning before Rachel Reeves' speech seemed to be good news for the Chancellor. What happened?
Yeah, so the Chancellor must have been delighted to have a bit of good news amongst the sort of doom and gloom, the usual doom and gloom. So, yeah, I mean, after rising in January, inflation actually went down from 3% to 2.8% in February. But however, that's still above the Bank of England's target of 2%. And it means prices are increasing by more than the government would like, really. So you bear in mind that inflation is nowhere near as high as it was back in October 2022 when the figure hit 11.1%, but it has been up and down for months now. So I think the Chancellor would really like to see that figure stabilize a little bit more towards the 2% figure. And in her speech, the government has signaled that they believe that inflation is going to get down to that sort of target rate by 2027, and they're committing to sort of work closely with the Bank of England and the Monetary Policy Committee to make that happen.
And so, with inflation where it is, Susannah, does this mean prices are increasing and we will be feeling a greater pinch?
Yes, they are still increasing, but not by as much as they were last month. So instead of the rate of price increases coming in at 3%, they're coming in at 2.8%. So yes, overall prices are becoming more expensive, but not everything. I mean, we had a real drop in the price of women's wear, for example. I think people are being a lot more cautious about their spending and not refreshing their wardrobes, quite understandably, perhaps buying more stuff on Vinted. I certainly am. And just building up their emergency saving pots, which I certainly think is a great thing to do. But obviously it has a knock-on effect because our economy is so reliant on consumer spending. But on the other hand, if we don't spend quite so much in certain areas of the economy, it does bring down the rate of inflation. So it's a double-edged sword. What it means is perhaps a slightly greater chance that the Bank of England will cut interest rates, although I don't think it's going to move the dial that much. We're still expecting the next rate cut to come probably in June and then another one by the end of the year. So we're not really expecting a rate cut, I don't think, in May, just because we've had this small dip in inflation, because it is still above target.
So no rate cuts yet, but right now then, what's it looking like for our banking, for our mortgages and borrowing, for our savings accounts? Matthew, do you want to take this one?
In terms of savings, I mean, the good news is that rates are still quite high. And our current number crunching that I did this morning found that 82% of all savings products currently offer rates higher than the current rate of inflation of 2.0%. And that includes instant access, variable rate deals, and fixed rate bonds and ISAs. So, if we look at the top rates, for example, you can get an instant access for 4.7% or a 1 year fix for 4.55%. And, this is, the reason it's important to choose an account with a rate above the current inflation figure is because if the interest rate on your account is below inflation, your savings are going to effectively lose value over time. So if you are thinking about saving, now is definitely a good time to look for one of these top rate accounts.
And make the most as well of your ISA allowances. Of course, the end of the tax year is looming, and we heard as well, despite some concerns that there might be a shake-up in ISAs, that actually the current thresholds are going to be kept intact for the next tax year as well. So on the Hargreaves Lansdown platform, we've got active savings, and you can look at the best deals that are around and then use that to maximise your ISA allowance if you haven't already done so. So, I'd reiterate that it is certainly worth moving now if you can. You have got some savings. And remember, it is really worthwhile to build up that emergency savings pot. You want between 3 and 6 months of essential expenses saved up in an account, just in case life throws you a curveball. If you're retired, it might be worth actually putting away 1 to 3 years worth of essential expenditure. But certainly if you're a working age person, 3 to 6 months should be sufficient. And interestingly, when it comes to mortgages as well, mortgage rates have already been easing off in recent weeks, with the average 2-year fixed rate mortgage deal, according to Moneyfacts, falling from 5.42% a month ago to 5.33%. Inflation coming in slightly lower than expected could strengthen this trend. If you are looking to remortgage, this is really positive news, but there is no getting away from the fact that you're still going to be remortgaging onto a higher rate than your current one, which is still going to be quite tough for many people.
I'm pleased you mentioned ISAs there, because many people were wondering if there would be changes to the ISA allowance in today's speech. But Matthew, there wasn't any direct mention, was there?
There was no direct mention in her speech. In fact, she didn't talk about it at all, unless I missed something. However, accompanying documents that went with the spring statement and were published after her speech showed there was a mention in the small print. After loads of speculation that the Chancellor wants to push savers towards stocks and shares, ISAs instead, lo and behold, you look in the small print, and the government does confirm it's still looking at options for reforms, with and I quote, getting the balance right between cash and equities to earn better returns for savers, boost the culture of retail investment, and support the growth mission. What that really means in reality, I don't know. We'll just have to wait and see, I guess. But it doesn't look like any sort of changes are being ruled out. So we could, for example, see, as rumoured, tax-free allowances be slashed, possibly to just £4,000. I mean, we talked about this in the podcast last week, or we could see adjustments to the personal savings allowance.
Yes, do go back and have a listen to that episode where we deep dive into ISAs last week if you haven't already. Susannah, I'd love to know your thoughts on this. Do you think it's likely that we'll be seeing changes to the ISA announced in the budget in autumn?
I think what is more likely is that we will get a consultation about any possible changes to the ISA before there's any firm changes made. So there may well be an announcement about a consultation, given that the supporting documents did indicate that the government was looking at potential changes, but there would have to be a consultation first. And what we would really like to see is the ISA regime just kept as simple as possible, because it's complexity in investment and saving that puts people off. And I think what we just want to see is a really simple framework going forward.
And can we just also talk a little bit more about the small print? Susannah, was there anything else mentioned in the small print that's worth giving a mention now?
Yes, certainly. There is going to be some changes in terms of the fines. If you do a self-assessment or a VAT return, if you're self-employed, a sole trader, or say a landlord, and you already use the kind of digital platform on HMRC, well, you may be faced with higher fines if you are late in filing your return. So the new rates increase to 3% of the tax outstanding where tax is overdue by 15 days, 3% where tax is overdue by 30 days, plus 10% per year where tax is overdue by 31 days or more. I mean, doing your tax return is never a favourite job, but putting it off could be even more painful for your finances in the future. It has to be said that it's only for those people who report via the Making Tax digital platform. So that's not everybody. However, this platform will be expanded to sole traders and landlords with over £20,000 from April 2028. So if you do file on the Making Tax digital platform, just be extra organised this time, because you could be facing a higher fine than you might be used to. But probably you're very organised and you've never been fined before.
And I suppose we should really give a mention as well to things perhaps that weren't talked about today that has surprised us or surprised the industry. Susannah, do you want to start here with anything that you were expecting or things that you thought should have come up or industry thought should have come up but hasn't?
I would say that one of the things that we wanted to see is a cut to the tax on trading shares in the UK, because the UK is a bit of an outlier compared to other countries. And for example, you don't have to pay that tax on trading shares if you're trading shares listed on Wall Street or on the Nasdaq, for example, those big tech giants, but you do if you trade shares listed in London. So we think it's an uneven playing field, and actually the proportion of clients who trade shares, UK shares, has actually fallen, and so it does indicate that perhaps if the tax was reduced, you might see an uptick instead of the number of investors in UK equities. And that, after all, is what the UK government says it wants to see. It wants to see the London market revitalised. So we really do think that actually it won't have that much impact on the exchequer if more people trade UK shares and the tax is slightly reduced.
Right at the top of the show, you mentioned that today's announcement was much expected, that it didn't rock the boat too much. I mean, how would you say today's statement has impacted the markets? Has there been a huge response?
No, there hasn't really been a huge response. In fact, it was a bit of a game of two halves, because initially when we got that slash to the growth forecast for this year, for 2025 coming through, you saw the FTSE 100 fall, as well as the FTSE 250, and bond yields, gilt yields rise, indicating there was a bit of uncertainty about how the government was going to balance the books if there wasn't so much growth. But then we had those forecasts coming through of an increase in growth greater than expected for next year and the years after that. And so that led to renewed optimism. And you saw the FTSE 100 and the FTSE 250 go back on an upwards path. And those gilt yields move back downwards again as bond investors seemed a bit more reassured. But overall, there really wasn't that much of an impact. And I think certainly that is what Rachel Reeves wanted to do, is try and show that the government is offering stability, and that was why you saw this measured response, I think, on the markets.
Well, looking forward then, any final thoughts for today? Perhaps anything that you're hoping to see in the autumn budget, anything we're waiting for? Susannah, do you want to go first?
What you heard in Parliament from some of the more left-wing members of the Labour Party were renewed calls for a wealth tax. And I certainly feel that this is going to rumble on between now and the budget. Of course, we've had a variety of wealth taxes in the past. Remember, back in time when there have been unintended consequences of wealth taxes, such as in old buildings, you've seen windows being boarded up because of the windows tax, which was meant to target wealthy homeowners. And there will be lots of different suggestions for this. Perhaps one of them would be to introduce a wealth tax via the council tax bands and add in an additional new council tax band. I think we'll have to wait and see really what happens to the economy, if there's a further downgrade in growth, if government spending overshoots forecasts from the Office for Budget Responsibility. I think then there will be questions raised again about raising tax in the budget. However, of course, I think that the government would do well to avoid doing that if it possibly can. And I'd actually like to see some more tax breaks, certainly for growing companies. We've had this pledge to increase investment in the defence sector with seed funding for drone companies, for companies using AI for missiles systems and that kind of thing. It would be great if we could see some kind of extra incentives to get smaller companies off the ground and help the economy grow. And going back to that tax on share trading, I would think that really should be looked at, because it could propel more investment in the UK market.
I should just give a quick note that we are going to be doing council tax on the show next week, also with Matthew on the show. So do come back and check out that one. And Matthew, is there anything you'd add here? Anything that you'd like to see? Anything which would like to see mentioned between now and, of course, the budget?
Yeah, I think one of the big things that could sort of pop up in the autumn budget is we've talked about cash ISAs, we've talked about stocks and shares ISAs, but the lifetime ISA feels very sort of overdue a reform. The main selling point of this type of ISA is that the government will pay you 25% bonus on savings to help you to help people buy their first home. But those limits have remained unchanged despite house prices rising over the years. And the Treasury Committee has actually launched a review into whether leases, as they're called for short, are fit for purpose. And they're weighing up a series of potential recommendations, including raising the property purchase price limit and ending the early withdrawal penalty.
Well, thank you both for joining us today. It's been a great episode. So thank you both very much.
Thank you.
Thank you. It's been lovely to be on the podcast.
Thanks for listening to this podcast from Which, the UK's consumer champion. You can find plenty more advice about what we discussed today in the show notes. There you'll also find a link to become a Which member for 50% off the usual price, an offer exclusively available to you, our podcast listeners. Joining Which will not only give you access to our product reviews, our app, one-to-one personalised buying advice, and every issue of Which magazine across the year, but you'll also be helping us to make life simpler, fairer and safer for everyone. Don't forget to hit subscribe wherever you're listening. That way you'll be notified whenever we release a new episode of Which Money, Which Shorts, or any other podcast that we make for you. And if you want to get in touch with us, then follow us on social media at Which UK or drop us an email to podcast@which.co.uk. See you next time.
Leaking roof? Car won't start? Needs to renovate? Here's what to look for when getting a trader to help. A recognised endorsement, where expert assessors set the bar high. Genuine customer reviews, so you don't get duped by cowboy fakers. A clear code of conduct to give you an extra layer of security. A robust complaints policy, so you can resolve disputes fairly. And the Which Trusted Trader badge that says, choose me with confidence. You can trust Which to help you find the right traders for the job. We run thorough checks on traders, put them through in-depth assessments, then we give them the actions to make improvements and only endorse them when they've actioned them and made the grade. So, to choose with confidence, head to which.co.uk/traders or search for Which Trusted Traders.